Hey everybody, welcome to a quick double bill. Two pieces of news today. I'm going to break the macro out into a separate video, and this is going to be followed by another video in about 10 minutes regarding interchains, cross chains, side chains, etc., and the impact of that on where we are today. But first of all, takeaways from the Fed meeting. Not the most exciting story as we go forward, but let's just jump in. This will only take a couple of minutes. Don't worry. Here you see many things are kind of breaking right now. Fed funds rate is now at 4.5% after the 50 basis points hit today. We are now 100 basis points above where I said we would be going into financial Armageddon. And remember, so far, only the real estate market is on the verge of crashing or has crashed in certain markets. And this is an interesting chart of the path they believe it'll follow. Obviously, rates will have to come down, but let's dig into what other people are thinking, like the bond market and some macro experts as well. But the market reaction to what happened today, we saw a very strong morning in Bitcoin, shot above 18,000. And then once the news came out from the Fed, it was totally buy the market, sell the news. I thought the market would rebound. It actually did. It tanked and then bounced, tanked again, bounced again. So the volatility was insane. And that's been typical all year after these meetings. But let's go a little bit further and let's look at some other stuff. What did JP say? Now, his press conference was really boring. I normally take away some nuggets, but it was like a complete repeat of what he said last time. So I didn't even bother doing that. But he did say the long-term median fair price for the Fed funds rate is 3.5%, which coincidentally, the first time I heard him say that, and that is kind of my breakneck level for the market. So I'm glad we're kind of on the same page there. Also, coincidentally, the 30-year was trading at 3.524% after coming down from 4.43% just a few weeks ago. The 10-year is at 3.481%, just under that magical 3.5. So you can see here there's a method to the madness, and I'm glad that JP said that. Now, what is interesting is when you look at what Northman Trader said, Sven Henrich, he said Powell made no sense. No rate cuts until inflation moves towards 2%, he said. And he publishes a 5.1% dot plot with rate cuts only in 2024, while CPI math is already implying a 2 to 3% CPI by the summer of 2023. That's 6 months away, ladies and gentlemen. And taking him at face value implies rate cuts next summer. So what the hell is going on here? It's like, it's infuriating. Either he's jawboning to keep a lid on the markets and bring inflation down through jawboning, because they know right now they're going to be printing about 1.1 trillion just to service the 31.5 trillion they have. And that's nearly 2 times the US defense budget, which is a huge item in the US defense budget. And forget all the other unfunded liabilities. It's really wacky stuff. So let's look at what the bond market sees right now. This is from Benjamin Levine. He said the latest Fed funds probability still have that 5% peak, but as the terminal rate, but 3 rate cuts by end of 2023. So that fits what Northman Trader is saying. Interesting. Let's talk to Mohamed El-Erian. What is he saying? And here he says, so much for credible forward policy guidance from the Fed. Despite what the Fed published and what Chair Jay Powell reiterated at his press conference, the markets are not buying a peak rate of 5.1% for the end of next year, at least not yet. Instead, they're pricing in around 4.4%. So this is kind of a weird situation. The bond market normally knows what's going on. The stuff that the Fed is saying that they're going to do, can they even do it? Obviously, I believe what will happen is they'll see the data that they'll pull in. It'll come in, 6 months late. They'll see the damage they've done. They'll recognize that they did say something that they know that what they put into effect today, it takes 6 months to work through the system. So that 50 basis points today, we will not see the impact of that till May, June 2023. Forget all the other hikes that they've done so far this year. Now, when we look at headline CPI, it's falling like a stone. We did have a little bit of the stickiness on the core, which excludes food and energy. That's the blue line. Headline is the red, and the median is the gold. But it is coming down fast, which is nice. and I expect that to tank a lot harder. Again, there's a few sticky items in there, a little bit of food, hopefully energy keeps it under control. But I proved in yesterday's video that the owner's equivalent rent and the housing shelter component of the CPI is way, way off the mark. And let's talk about housing for a second and how the real estate market is crashing. I shared this last week, but here, the real estate market is the fastest slowdown on record, fastest ever in history. 7 months smashed. Never before has it fallen this fast, this far in history. And this is what I mean by elements of financial Armageddon. So at the end of the day, it's probably nothing. So with that was the quick takeaway from the Fed funds rate. Who knows where we're going to go? Something's going to break. They're going to have to cut. They'll probably wait and say, well, we had to cut because we had this recession, or, the inflation numbers were where they wanted to be, etc. But that's going to come. The market did not react as positively as I would have imagined. The other final question that we have is the Santa rally, the last 2 weeks of December, off? Last 2 weeks of December starts in 2 days, ladies and gentlemen. So let's watch that carefully. I still believe there's a good shot of it happening. But let's just hang in tight and see what we can do. In the meantime, take care, everybody. I look forward to the S&P hopefully getting to 4,100. It hit it yesterday briefly, but not enough to catch it. Thanks all. Bye.